In pre-market, they raised guidance for net interest income to 81 billion from 73.4 billion. Sorry, and I'm sure you guys touched on that already. But now seeing the cap kind of being lifted, some of the large cap banks names, even Wells Fargo up a little bit over 4%, might be the antidote for some of the indecision. But the way the indexes are responding right now, I'm not certain. We'll see how the regular session goes.
Yeah, banks stuff is now. The first week, there's 67 billion that went to the big banks, and JP Morgan's still paying, less than 10 bips on deposits. So they saw huge NIM expansion. So did Wells Fargo. Wells Fargo saw obviously charges, right, 600 million, and those charges will continue to grow. But the NIM expansion at the big banks is not a surprise. We had that view on PNC. We also were positive on other super regionals. It's the smaller banks that you have to worry about. That's why the market's not participating. Until you see like the mid and small regionals, you see a relief rally there, you're not going to see the market participate.
So, from the earnings call, JP Morgan CFO said the deposits in the system are shrinking as a whole due to quantitative tightening. And then Jamie Dimon said that there will inevitably be a recession. Interesting, since Robert was just saying was taking the other side of that. A recession may be pushed off a little bit. By the way, U.S. retail sales month-over-month actual negative 1% just coming out. Forecast.
So I don't understand how you could say there is no recession. I mean, you look at all the leading indicators. You look at PMI, ISM. You see retail sales negative 1%, which, by the way, unit sales are down a lot more. You take into account inflation. Like real sales are a lot lower.
Yeah. So yes, unit sales are lower. Year over year, also U.S. retail sales actual were 0.94%. I don't know what the forecast was actually, but I don't have that data in front of me. But yes,
it was 0.4%, right? So it missed by 60 basis points.
So I mean, how anybody can say that we're not in an actual recession? Yeah, you're right. It was a surprising comment, but again, I think he's always been, even on our space, spiteful.
Depends on how you define a recession. Are we going to see 2 quarters of negative GDP growth this year? Maybe we won't, simply because when you think about GDP, it's a nominal framework, right? So that means you're including inflation in GDP. Okay, so if GDP is not negative for 2 quarters, I wouldn't be surprised, but that doesn't mean we're not going to see an earnings recession and a consumer recession.
Interesting. Alan, did you have something?
Yeah, I just reading JP Morgan's, the largest item of earnings was what they're defining as interest income, rose 40%. So just to go back, Robert was not the oldest person in the room. I was at UBS when Robert joined UBS. Robert joined Wall Street in 86. I started in 73. He may have known Volcker, but I lived through Volcker in 81. And I know Jay is involved in the high yield marketplace. I was involved with it in the 80s, as I used to say. I was the only uninvited high yield trader in the 80s. So I have a little bit of a track record here. To go back to what Robert, remember Robert is left leaning, so he's definitely Obama-ish and Biden-ish. So you have to take his view on what's going on to be as well as astute and have a long-term meaning. A lot of the political politics in there. Just a couple of things here, and Jay, I'd like you to reach out on this. The 10-year Treasury, which I find to be the key barometer of what drives the marketplace, not the bank's earnings because they fluctuate, but the 10-year bond right now is yielding the spread between the 10-year bond and the German 10-year bond is 111 basis points. A year ago, it was over 200 basis points. So what's happened during that time is European rates have gone from minus 85 to 2%. ours have gone up. But in the last couple of months, our rates have gone down, and that corresponds with the number of indirect buyers of our U.S. Treasury auction, which is up to around the 67 to 70% of our auctions. Dealers are taking the lowest percentage of the auctions that they've ever done. In most cases, under 10%, and the direct buyers fill in the blanks somewhere between 16 and 20%. So what I see here in our Treasury market, and what's bringing our Treasury rates down, is a flight to quality. My biggest signal in the marketplace was who's doing the buying, who's actually buying securities. And this is the greatest indicator that you can have looking at the auctions. So went through the auctions this past week, dominated again by indirect buying. So is that a flight to quality? Well, what that does is when you have that spread contracting between 10-year bond and U.S. 10-year Treasury. Also, the euro moved up. Why did that move up? Because now the European rates are yielding at 2% instead of negative. So right now we have a whole bunch of things going on. Bank data, I don't look at the bank numbers. This has become, since I started, and again, Robert maybe should have commented on this. We didn't have a trading desk on our trading desk. We didn't have computers until 1990. So right now you have a social media marketplace, and it's controlling everything. You are looking at headlines. No one's looking under the covers. I don't buy bank bonds because I don't look under the covers. I don't know what's there. They're not taking losses. They're taking reserves. We don't know if those reserves are accurate. This is on the yield to maturity portion of their portfolios. So until you do your deep dive in the banks, I would stick to the sidelines. PNC is a spectacular bank, and yes, it is a regional bank, and yes, it is a large commercial bank. But I would say that with the trillions of dollars that JP Morgan is making on interest income, that's what's going on. Just to give you an example, in 1990, you guys may have heard this. I was at a firm called DLJ, which was owned by Credit Suisse, and we had my high yield inventory was $1 billion. The whole market was $150 billion. The high yield marketplace now is $2 trillion. So what is $2 trillion? And I don't know, and maybe you can comment on this. I don't think the top two dealers have $1 billion of inventory. When you break the high yield index down,
you don't take any inventory risk.
I call them waiters. Can I have that order, please? They don't take positions. So part of this liquidity or illiquidity issue that we have in both the Treasury market, the corporate bond market, there is no municipal market, no matter what anyone says. Okay, and this organization, they have so much concentration, whether it's JP Morgan, Citadel, Peru, or anything else. They have no more broker dealers. And broker dealers were the essence of the marketplace now, and that was caused by the removal of Glass-Steagall in 1998 by Wilson and Clinton, Bill Clinton. But further, it goes back to '86 when Robert joined Marketplace, where Congress passed the ability for banks to own stocks and brokerage firms. And the banks, and Robert also touched on another thing, leverage at UBS was 35 times. By regulation, the U.S. regulation was 20 times. So the banks, the brokerage firms, so the banks then had to participate in this market to give the brokerage firms more capital. Now, I spent a lot of time not talking about the market, but right about now, the trader has three things. J stock, you guys can comment on this. Buy them, sell them, or do nothing. The hardest thing is doing nothing. And Robert did touch on one thing. There are global economic macro situations just enormous here. I'm going to ask this question, Ariel, guys, maybe you can put this out. What do you think is going to happen first? Peace in the Ukraine China invading Taiwan or war in the Middle East. Now with the relationship between Saudi Arabia and Iran. Right now I'm sitting on the sidelines. I'm sitting in bills and shorter-term treasuries. I do have some high-yield stuff. I do still dabble. But I am, and I do have my golden stocks, my Microsoft, my Apple, my Iridium, things of that nature. Okay, but right about now, and you guys can comment on any of those things. I'd like to hear.
Yeah, Jay.
Jay's
go for risk. I mean, I will say that
when it comes to the geo, I think that the war in the Middle East isn't really in the Middle East isn't going to change much because of this.
Exactly.
They call it like a pseudo diplomatic relation between Saudi Arabia and Iran. I mean, it's more of like a beginning of relations than actual relations, and it's there for economics. So they can control oil supply together. I don't think that it's an actual diplomatic relationship. On China Taiwan, I will reiterate this. I don't think there needs to be a war. I think China basically knows that they control Taiwan.
Everybody
they're the biggest landmass across the Taiwanese Strait. They have a big place when it comes to trade. They could blockade Taiwan without even lifting a finger. Taiwan needs to import all its foodstuffs and its textiles and all the ingredients it needs for its biopharmaceuticals and its semiconductor industry. So China effectively controls Taiwan already. So I think that there might be some posturing, but in the end, I don't necessarily think there needs to be a war right now. And when it comes to Ukraine, Russia, I mean, one can only hope and pray that it ends soon, but I don't think it's going to end soon. So there's a risk of inflation and another energy crisis. Sharif Suki, who started LNG Chenier, he was speaking yesterday. He's a man that I respect because he built Chenier out of nothing. He's had some difficulty because of, with Tellurian, he built Chenier at like $600 a ton. With inflation, it being 10 years later, costs have risen so much that he needs to fund this entire LNG project with, a sale leaseback and dilutive equity offerings. So Sharif was basically saying that Europe's going to have another energy crisis because they simply just don't have enough storage for LNG in enough conversion capacity. And renewables aren't going to do shit in a cold winter. So I agree on that third point that this Russia-Ukraine issue could flare up again unless one of the two parties backs down. In the near term, it doesn't look like one of those two parties is going to back down. So that the geo risk is there, and I think there's another risk that we haven't talked about, which is the media risk around this debt. There's going to be an article, in every single paper, every single day, talking about the U.S. default, about not being able to pay U.S. postal workers, even though I think we're going to pay our debts eventually, right? Because of the bipartisanship in Congress today, if you can't get those guys to agree with each other, or push this to 2024, which would be just kicking the can down the road because that's a political year, this is going to be a big issue for us, right? That's why you're seeing, alongside some of the other geo risks, why you're seeing gold above $2,000 an ounce, why you saw the miners break out, GLD on the gold front, GDX day, the junior miners had a great day yesterday. It's primarily because of that.
Just one thing I saw rollers on the tape, core inflation not showing much.
Yeah, so yesterday, that was a good point. Yesterday, one of the things that was surprising was that, inflation, PPIB and the day before CPIB, but the fact that core inflation is now higher, right, than headline inflation, kind of proves the point where I was saying goods inflation was going negative. Goods inflation is slowing down, but wages are still sticky. So because of that, the Fed has to continue to hike. And 5.5% rates, it's nothing to laugh at. We have, trillions in corporate debt, government debt, consumer debt. You need to be able to service that debt. And it's not just the $1.5 trillion of commercial real estate that's coming due. You have trillions of corporate debt that's going to start maturing in 2024, 2025. So, it's easy to say, we're not in a recession when you realize how much interest costs are going up and how much margins are coming down because of interest and because of wages, these companies are going to have a very difficult time, especially in some of the smaller businesses that are not publicly traded, that can't issue stock, or they don't have flexibility where banks don't want to lend to them. So I think it's a very major issue, and you have to wait and see how the smaller banks report, and they're going to struggle to increase their lending.
Yeah. By the way, Jay, can you hear me? Just want to make sure that you can hear me before we keep moving. Otherwise, can we send Jay down and bring him back up? Sorry, stock market news, Evan. Any breaking news or any updates?
Yeah, I was just going to let you know we have two Fed presidents speaking right now. They've been speaking for a little bit. Fed President Waller and Goolsbee. That's why the market was kind of moving lower. Just one quote from each. Waller came out and said recent data shows that the Fed hasn't made much progress on its inflation goal, and more rate hikes are needed. And then Goolsbee came out and said a mild recession is definitely on the table as a possibility. So a little bit more hawkish on both of them. The market kind of took it lower. I also saw that the Fed towards more rate hikes than the other way. So interesting to see how the market reacts to all this, but market moving lower off of some Fed presidents.
Perfect. Jay, can you hear me now?
Yes, and
Maybe. Okay, perfect. Yeah, sounds like your connection's not great. So Patrick, great to have you this morning. How do you think the markets are reacting? And I know your commentary yesterday around looking at the bigger picture. We just had Robert Wolf on stage, and we had a full conversation with him. He is now even more convinced, and I agree with Alan, the other factors involved, but he believes that we're not going to see a recession. We are already in a recession, in my opinion. Patrick, would love to get your thoughts.
Well, this is a thing now. In the most recent past recessions, and you have to look at the market. If you're always waiting for the Fed or whoever decides what a recession is, we know how it is, right? They backfill it, and sometimes they even change whatever their criteria is. Let's say, finally GDP was negative for that quarter. So, like in the 2008 recession, like when did they actually say we're in a recession? Because when you look on the charts on their official data, it says a recession started, I think, in like 2007, So what you have to do is you have to look at the charts. You have to look at silver, which is a recovery metal. You have to look at oil. And most of these instruments, especially silver, loves to bottom in the abyss of a recession. So in hindsight, in the future, one day when silver just had its drop to $19 a few months back and it started to recover already, it's possible that in hindsight they will backfill a recession that started a little bit before silver started plummeting its previous drawdown. And they'll say that the recession is on, like they'll probably say we're in a recession, but silver will already be recovering and pricing in the recovery aspect of it. And you could see it also in the U.S. equities going up. So
Actually, Patrick, one point is everybody was really scared about DXY or the U.S. dollar index. It has made a little bit of a bump off the resistance. It's now up 18 basis points. What are your thoughts, Patrick, on that? And then Alan, would love to get your thoughts as well.
The DXY, it behaves like the VIX. It behaves like the gold-silver ratio, which those metals are financialized. Whenever you see the gold-silver ratio spike up, usually it's because gold could be staying flat, going slightly down, but silver is sold off heavily. And again, silver bottoms and is sold off in the abyss of recession. So if the DXY decides to climb back up, we will have to keep a close eye on the gold-silver ratio. If the silver is not able to outperform gold, then that's the markets, the market participants actually telling us that we're in a risk of we are heading into a recession or we're deepening into one. But I would trust way more the behavior of metals, of the gold-silver ratio, of the DXY than I would any headline news or official people telling us that we're in a recession or not. Because when they tell us, we're most likely already climbing out of it.
Alan, what do you think?
I think it's obvious that you saw, and I look very closely at this spread between the 10-year bond and the 10-year treasury. I don't know what the Dixie is. days ago, it's 111. So as that spread widens, more people will go to the dollar. The dollar will have more buyers, and that's what happens.
That's super helpful.
That's reality.
Explain that a little bit more for our audience. That is a very critical point that you were saying. So, as the 2-year, 10-year spread,
Why nothing to do with the 2
why
years.
do people go into the dollar? Can you give a little specific? Sorry, we have a lot of people that are looking to learn.
Okay, here it is. The 10-year treasury. Okay, let's go back. The German bond was minus 85. The U.S. treasury was 100, 200 basis points higher. Okay? So it was trading at 1.5, let's say. Well, at that particular time, the spread was 209, and the euro was, at one point, challenging parity par, right? Everyone was on 102, it's going to fall down to below 100. All of a sudden, what happened in Europe raised their interest rates. The compression between the 10-year and the European and German 10-year bond went positive. Our rates went up, and as our rates went up, theirs continued to track. Now, their rates now are presently 110, 111 basis points behind our rates. But as that spread widens, people in Europe and other countries will buy dollar-denominated securities. And that's been expressed also by the amount of indirect buyers of U.S. treasuries. And I put this forward in my previous comments, that almost 70% of all our auctions are bought by foreign entities. We don't know what they are. They don't define them. So right now, you have this situation. I don't look at the Dixie, only look at the euro and the spread between the 10-year treasury and the 10-year bond. If that continues to widen, the dollar will improve. And it's just and this is, okay, I've been following these spreads now since the 80s. And this volatility and our access to data just makes these things much more important. And one other thing about the earnings, everyone's taking up J.P. Morgan. It's in here that their profit was up 1% in investment banking. So that means most of their stuff was inflation. Now that goes back to what I touched on, and I guess Jay is probably more current about. The talking heads and what people perceive to be reality is not accurate. And data that we get from our federal government and other entities may be misconstrued. So you have to be very careful, be very finite. I like what you said about gold in here. I missed your name. But Patrick was excellent, spot on. But remember, gold and silver are priced in dollars.
So I want to make sure, Alan, I really want to make sure that people understand this bigger macro point that you made. People chase yield. If you can't get yield in Europe, those investors will chase yield in the U.S. There's
Correct.
There's a gap between the 10-year in Europe, specifically the German bonds, versus the U.S. bonds. They're going to come in, they're going to, quote unquote, invest in America, not because, and this is the beautiful thing about our space compared to a lot of other folks, is that we speak very dispassionately because people have got to make money. And this is how the world works. And so ultimately, they're going to chase yield. They're going to come in, invest in American bonds, which then will push the dollar up. Patrick, you guys want to say?
Yes. I was looking actually at the delta. So I did, let's say, the Fed fund rate minus the euro central bank overnight lending rate, and it's on point. So it's always the delta. So if you overlay the currency, the euro USD pair, to the euro central bank minus the Fed fund rate, they track practically the same. But you have to zoom out to see that type of correlation. So yes, the 10-year yields and all the yield curves. If it's getting better in Europe, or they're catching up towards what we had in the States, then the euro will start gaining steam versus the dollar, and vice versa. So the charts are definitely, in my those capital flows as defined by the yields on those currencies driving the actual price chart of the Dixie, which is primarily, I think, like 58%. It's actually like the Euro USD pair.
Yeah, it's really interesting. That insight, Alan, was great. Neely, I just want to make sure.
One other thing, Jay made comment on this. You talked about chasing yield. You're 100%. You're spot on. And right now, people are chasing yield, the high yield 8% yields. One thing they failed to realize is that almost 800 issues in that index, which is 2,000 issues, are triple C, which are trading above 13%. And chasing that 13% correlates to the default risk that Jay mentioned. So we're 100 points spot on. They're buying yield, they're buying risk, they moved away from the SPACs, they're looking for other things to buy. And Jay, can you comment on the spread between the double B, single B, and triple C in the index, high yield index?
Yeah, Jay, what are your thoughts on that?
Sure. I mean, the spread between the double Bs and triple Bs, and basically just the high yield spread itself, you can actually.
Yeah, can you also explain to folks what we're talking about?
Sure. Right. So a high yield bond is essentially a bond where you have a rating below triple B minus or Baa3 by S&P and Moody's. And, it's over $1 trillion market. You also have a high yield loan market, which is over $1.3 trillion. And then you have a private debt market, which is $1 trillion. So you've got $5 trillion in leveraged capital markets, for mid to large size companies in the United States. These are companies that are having trouble issuing bonds right now because of how high rates are. And the market tends to look at high yield spreads because high yield spreads estimate a probability of default less recovery. So, that spread, that premium, compensates the investor for the liquidity risk and for default risk. And when spreads are going up, it means that the market is pricing in a higher probability of default, which is also a leading indicator for unemployment. Because when you see higher defaults, you see more layoffs, which is why the Fed focuses on this. The spread, in the high yield market, really peaked out last summer, where you saw high yield spreads, kind of gap up. And what we've seen is they've compressed relative to where we were at the peak of last summer. And we don't feel that if we enter a recession in 2024 or at the end of 2023, that high yield spreads are compensating investors enough for default rates increasing. And that's something important to understand. Most of the yield in high yield is coming from the rate aspect because high yield spreads are on top of the U.S. Treasury yield. So if you have a five-year bond and 5-year Treasury, more than half of your yield right now is coming from the risk-free rate for the Treasury, and a smaller amount is coming from the spread. What was mentioned is that investors are taking too much risk chasing yield. In fact, I've seen in my career retirees tend to lose the most money, chasing 13, 14, 15% yields, not understanding that the risks that they're taking when they're buying those types of bonds are magnitudes higher, right? Like 20, 30 times higher than buying a bond, with a 6% yield. So, there's going to be a misallocation of capital, because right now the market, there are people who think that we're not entering an economic slowdown and they're buying risky bonds. They're buying single B bonds. And, there's going to be a huge downgrade cycle like we saw, not as fast as 2020, but when you enter an economic slowdown, you see downgrades accelerate, and that forces I'll give you two perspectives. On the loan side, it forces forced selling because 80% of the loans in the United States are actually not owned by banks. They're owned by collateralized loan obligations, CLOs. And they have these ratings buckets where if you have triple C's over 7.5%, when a single B is downgraded, it becomes a triple C. And when your buckets go above 7.5%, all of a sudden you're forced to sell those bonds or mark them. And it's a very difficult position to be in, and it shuts down the loan market. Same thing in the bond market, right? There are forced sellers like insurance companies that can't own a significant percentage of high yield bonds. So and specific mutual funds that can only own IG bonds. So the single B market is the biggest it's been relative to the total high yield market. So if you see even a soft recession, you can see the number of triple C's jump pretty materially, and you can also see a number of triple B bonds go to double B from investment grade to high yield. You can see forced selling. That could shut down the high yield bond market. When the high yield bond market and the loan market are shut down, companies can't refinance their debt. That's when defaults go up. So
that's scary.
I'm not in front of my computer right now, so I can't give you the exact spreads.
One thing I wanted to circle back on is a bit of a pivot, but I know we have Neely here just briefly before she has to run, so I wanted to get her to touch on this. But we got retail sales this morning as well. I've been at the top, printed negative 1% month over month versus negative 0.4% expected. So pretty big miss there. But Neely, I'd love to get your thoughts just generally on retail sales as well.
Dave's sucks. I plan to hop up because this is a big miss. It's not just a big miss on the month over month number, but if you just look at the deceleration and even some of the categories, we track this. Nearly 70 categories we track it broadly. So I would say just on a year-over-year basis, unadjusted, which is the way that retailers will typically look at it because that's what really happened. And that's actually how they budget. It was up 3.1% in March, a massive deceleration from 6.1% in February, and a further deceleration from January's 8%. So you've gone from high single to low single in just 2 months' time. That is a big issue as it relates to planning. It's the slope of the decline that concerns us. But when you look at some of the categories behind the scenes, it gets even a little bit more confirming to our broader thesis around what's going on with SNAP benefits and tax refunds. General merchandisers in February, they were up. This is think of it as the Targets, the Walmarts, the department stores, the dollar stores, right? That sort of category. They were up 10.9% in February. They were up only 2.9% in March. So that is a massive deceleration from 1 month to the next, and certainly would be concerning us as it relates to the profitability of the sector overall. So,
what is the hypothesis here, Neely? What is the cause?
Well, as we mentioned yesterday, we're concerned that the consumer's capacity to spend has been challenged. Dynamic, people losing healthcare potentially, some concerns about that. You also have tax refund dollars go down close to 20% year over year. The total economies, the tax refund dollars in total were down 20% for the month of March. So that is that's less money in people's pockets.
I'm trying to get you to say the word I want. The consumer is not as strong as everyone pretended.
Right,
That's what I'm
right.
This is why a full recession made no sense.
Exactly.
Recession. Of course, they're disloyal.
And I think the importance of retail sales, of course, we're data nerds, is that this is data reported by businesses. There's a lot of government data that's reported by people, which is a little bit less reliable because it's how are people feeling? Do they actually fill out the form? Do they include tax and tip on whether or not they said their restaurant sales? Right?
There's selection bias.
Correct. And I've never filled one out because I won't take the time to do it, right? However, businesses are required to fill out these forms. They were required to report them into the Census Bureau. And so retail sales is a sturdy set of data and something that needs to be attended to. It is representative of the goods side of the economy, not the services side, broadly speaking. But, this is by the way, including inflation. So it's a problem that it's decelerated so much. We haven't seen these levels. I went back and looked at our data. We haven't seen these levels on an absolute basis since late 2020, early 21 in terms of the overall retail sales number. This is a big deceleration.
And Neely, you just said a good caveat. The other side of the coin would say that services has perhaps made up for goods, right? I mean, we know that people are talking about this, but
Yeah, and it's about 50-50 right now in the economy. You have about, historically, prior to the pandemic, we were about 40% goods, 60% or so services. We're now, these are just rough numbers, but we're now closer to that 50-50 mark. So it is only about half of the consumption piece.
exactly. Yoder, do you have a question? I know you have a question about the euro dollar dynamics.
Yeah, hey man, I don't want to disrupt the flow if you guys are mainly focusing on specific, but I do have a question. Wait.
Go ahead.
No, I just thought it was quite the economic dynamics of China. What that has been doing to obviously comments around the euro market in the European continent in the past couple of seems to have obviously damage control trying to be done, and the US has been pretty hawkish on the comment versus other comments in the European who have actually been more tacitly endorsing these comments. So I was just wondering, for those who were talking about the US dollar versus euro dynamic, if they had any thoughts on those implications, the political risk going to it, if that could potentially play out in the case of remedy and the dynamics of Asia as well.
Yeah, Alan and Jay, you guys have any comments about what's going on with Europe? And sorry, yeah, go ahead.
Yeah, that makes sense. So you have an environment right now where people think that the U.S. is going to slow the pace of hiking well in the Eurozone. It looks like they're going to continue, and that perception of a change in interest rate differential is negative for the dollar versus the euro in the short term. Just like in the prior year, while the U.S. was hiking much faster than Europe, the euro was collapsing versus the U.S. dollar, and there was also some risk in Europe because of what's going on with Russia and Ukraine. So, this is kind of just a mean reversion of what you're seeing, and European growth has been stronger than many expected because Mother Nature was very kind, and we didn't have a cold winter, and we didn't have the big energy crisis that we expected. Even today, there are over 5 very large agricultural fertilizer factories shut down in Europe. Like, there are steel mills and aluminum smelters that are down in Europe. Like, the economy was under threat. Like, they could have shut down 20% of the economy if you had an energy crisis. And they didn't. Luckily, they didn't have to deal with that. I think that there's another risk of that this winter. But the euro differential, to answer your question, if I heard it right, is because of a perceived change in the first derivative of interest rates, and also because of the fact that their economy is doing a little bit better, and Europe benefits from a China recovery, right? You sell luxury goods, you sell LVMH. Europe is set to benefit more than the US from the Chinese economy.
Yeah, and I think the big question though is, Jay, with all of this money going into the dollar potentially differential, what happens to Europe?
And can I just take on to that? What's your take on the IMF forecast for the past couple of days? I think they revised the rest of the art, generally they're quite poised for the European continent. I think the UK is screwed, obviously, but just curious of your take on those projections. Thanks.
Yeah, so I really don't pay much attention to those. I think those projections usually are wrong. I tend not to focus on them as much. I agree that the UK is just not in a very good spot. I think that as long as we don't have an energy collapse, I think that Europe is in a much better spot than we were last year. I think that the U.S., while we may not see negative GDP 2 quarters in a row, especially this quarter, we will see a material slowdown in consumer spending for the reasons that we discussed yesterday, and Neely's discussed. You're already seeing it in retail sales. I think you're also going to see an earnings recession. The big banks that you saw today, why did the market sell off after the rally in the free market? After JP Morgan reported, BlackRock reported, Wells Fargo and Citi reported. The big banks were always going to be, right? You have a checking account with Chase. Chase is paying you nothing, and interest rates are at 5%. Of course, it's going to make trillions of dollars in net interest margin, right? Same thing with Wells Fargo, same thing with Citi. When you need to see some of these smaller companies report in the second half of earnings season, see how much they're suffering from margin compression and what their outlooks are. And I think that could turn a lot of people's heads. And if we do have an earnings recession, right, it's going to be very difficult for the market to have any legs, right? Above 4,200. So that's kind of how we're thinking about it. For the European market has exceeded, right, the performance of the U.S. market because the banking concerns have primarily been in the U.S. And for the last 15 years, the U.S. market has outperformed the European market on almost every metric. This is a period of time where it makes sense, right? Given the P differential, given relative growth dynamic and outlook for the European markets do a little bit better in the short term. So hopefully that addresses the question that you have.
Yeah, there's another point here that I want to make. You start looking at forecasters, whether they're economists, whether they're analysts. Sorry, someone just brought up the point that JP Morgan exceeded the analyst expectations. Last quarter, the companies beat the analyst expectations by 71%. Now, I'm going to turn that around. That's the analysts were 75%, 71% of the time. Okay, so if anyone thinks that analysts and economic forecasters are fallible, they have a very, very large problem. The other thing that is interesting on the France-China thing, well, we know that France has flip-flop and everything, and always from the strongest power, which upsets me the most. That if France is kowtowing to Brazil is kowtowing to China, it shows that maybe the U.S. is not as strong as everyone. But the leadership, let's say, is not as strong. It's not as strong as they can be. Really made some great points. And Jay,
But Alan, is it leadership, or is it just that they're doing more business with China? Right? I don't think, from an economic perspective, right, France is just doing a lot of business with China. So Brazil, China imports 60% of the world's commodities, right? So Brazil, their biggest customer is China. So just logically, from an economic expediency perspective, I think it makes more sense for them to, be nicer to China simply because they're earning more revenue.
Oh, you're 100% right, but when is the U.S. going to wake up and smell the coffee? I posted this on Twitter. 90% of all generic medications that consumed in the United States and in the world are produced in China, India, and Brazil. And that used to be a flip-flop in 1998. Okay, so now unless we start, and that's why this chip progress thing of building chip plants in the United States, building up rare earth manufacturing in the United States, bringing more things back to the United States, since China just more than anything else. Because unless we grow our economy, and we're just not consumers, I ask this question all the time. Is Apple a Chinese company or American company? Well, it's made in China and consumed in the United States. So, that's what
or at least the idea.
Exactly.
And also, not only that, I think they moved 7% of their assembly to India. They're moving the MacBook production to Thailand.
Well, wait a second. Why didn't they move it to someplace in the United States, which would benefit them? It's a kidnapping, guys. That's part of the problem. It's not liberal. Okay,
I don't have to make that. If you find a way to bring numbers back to the West, they have to be a financial case for it. They can't just be a governmental case. But I was going to say that
we can't. Let's just do 1 second. Okay, I'm not talking about a financial thing here. I'm saying about you can't. Someone once said to me, "Oh, we can't bring it back here because it's the shareholders to make money." Right? Okay. But these companies Apple would not have grown if they hadn't been in the United States. So there's why
the intellectual property is kept in the United States.
Yeah, so why don't we bring back some of that revenue and take it? What's the town in Oakland? Build a plant in Oakland, California, where they have a huge amount of violence, huge amount of unemployment, where the people's hands in Oakland are not any bigger than they are in China.
Well, you add your iPhone on $5,000.
But you're 3.5% unemployment, and you don't want your son or daughter like building small transistors onto a circuit board, right? Like that's not the type of
That's not what you remember what Robert said. He brought out a point which showed his left wing and said we have a social safety network which will help people in the times of a recession. That's my concern right here. We have more people that aren't working that are collecting government subsidies, and we have to figure a way to get that done.
Well, so this is this question. Now, maybe this. I mean, I think this is awful that this didn't happen. But a bunch of people get $50 donation, and so as a bunch of people get off of Medicaid, they'll be forced to go into our sort of barbaric health system where they have to get access to healthcare through their employer, which I think is completely nuts. Alan, if you have access to Medicare, perhaps most people in this country should have access to a safety net. I'm not going to, again, and just so everybody knows, I'm actually very right. But when it comes to healthcare, that's a good right. All right, so let's keep moving on. I want to move forward. The manufacturing numbers, kind of interestingly, actual came in negative 0.5%. The market expectation was negative 0.1%. Previous, for people that don't know, was 0.6%. Manufacturing numbers pretty bad. As a reminder of what Alan was saying, and so as we start wrapping up today, we'd love to get people's thoughts on what are you looking at today, and what obviously geopolitical risk is high. I'm actually not convinced that it's as high as people think it is. I just don't think anything's going to happen. And I will tell you, I think the Russian-Ukraine war is going to go on forever, or for a long time. I think China is not going to do anything in Taiwan. This is just people bumping their chests, and I think that ultimately, the Middle East, I don't know if people know this, but that's probably been going on for a while. It always looks like it's going to bubble up, but it never does. There's just too many entrenched interests here. So,
and economically speaking, I think that there is a very interesting power vacuum being created, and like the increased relation between geopolitical actions and, let's say, market participation is actually increasing, especially within the, let's say, euro demand for US dollars. To your point, being down there has been talking about that quite a lot, specifically with currency swaps and other forms of derivative products that necessarily illustrate the demand needs for the let's say, euro structure or eurozone in relation to, let's say, the United States. What I find fairly interesting in this development is essentially we are seeing this power vacuum that it won't necessarily mitigate itself anytime soon. Right?
Exactly. And ultimately, I will say that it might be time again for us to take a victory lap around the fact that China is not going to be the global reserve currency. The U.S. is not getting hyperinflated, and everything is going to be just fine. I think we have much bigger things to worry about in the long run. In my opinion, it's a deep recession. I honestly, I'm a little bit in shock that Rob is confident that we won't have a recession at all. I'm not sure if that's what he meant to say, and he said it in that way, but I think it's kind of interesting that was his initial point. But even beyond that, I think that what we're most worried about, in my opinion, right now, is deflation. It seems like deflation is going to be managed possibly by just the global economy. But the biggest risk in the U.S. right now is deflation. Has anybody been watching the crypto market? Can someone give us a crypto market roundup?
Yeah, let's talk about roundup. It kind of both has gone sideways. I mean, it was up, on the news. JP Morgan about 2% this morning, starting from when banks earnings calls happened. So, not decoupled yet, but all calls for getting decoupled from high beta stocks not yet occurred. But I think it's like sideways.
Yeah, I mean, it's not something that there was no.
It's up 0.9%. 0.9%.
Sorry, go ahead. I kind of do want to bring up one of the things is, I think there was a comment earlier about kind of euro and how it's trading. I thought that discussion was fascinating. Alan and some other folks.
One other point I forgot to bring up was the amount of euro defaults that are taking place with higher interest rates and restructurings has gone up significantly. I'm seeing at least one or two a day. What do you think about that, Jay?
I mean, the number of defaults we've seen this year is the highest it's been since the first and second quarter of 2020. And that is not something to be taken very lightly. And what that means is, when a company defaults and files Chapter 11 bankruptcy in the United States or an lesser case, Chapter 7 liquidation, there have been a number of companies, like recently you saw Tupperware, which is a household name, announce that it was not a going concern, which means it's going to file for bankruptcy soon, right? You have Bed Bath & Beyond, which is like on the brink. You have AMC that needs to restructure, right? There are going to be companies that you know, Party City, like there are going to be a number of companies that with brands that you know that are simply could go away, right? Or find themselves under new management, new sponsorship. So, this is something that I know the Fed is looking at. It's not really covered as much in financial media because these are usually smaller companies. The bigger companies, especially during COVID, they extended their maturities out. They refinanced their debt, just like you refinance your mortgage. They pushed it out. So you're not going to see huge companies, but you're going to see hundreds of small and mid-sized companies go bankrupt over the next several months simply because of where interest rates are and a slowing economy. So I do think it's material. You're going to see more of that, I think, in 2024 and 2025 unless we get into
The other thing to ask about is, of course, the VC market, or rather, the market for startups is, as someone pointed out, much smaller. But we're going to see some similar things happening there, and a lot of small businesses.
Can you explain to me what? Exactly. Are you talking about the VC market, or are you talking about the VC market?
No, I'm mostly talking about the North American VC market, but the Bay Area VC market, which is essentially the greatest portion of the VC market, so obviously very localized market.
And you can put it in context a little bit for both sides. But for people that are not aware, this has been the least active VC market since like 2019. The first quarter has been essentially everybody sitting on the sidelines, collecting management fees. There's been a significant drop off.
Yeah, absolutely. And I'd say there was a joke that what's up, we were chatting about how we were talking about, hey, maybe we should do a VC roundup, a VC deals roundup, but actually it's kind of like, well, VC activity these days is VC AI activity. It's almost ontology, right? AI is the sector, which actually should give some, bright spots. But you have VCs basically looking for AI deals. And I was on an AI investing panel just yesterday here in New York City when I'm visiting. And, I was at GDC where it was all about AI. And the big questions around capital, but not to get down the startup rabbit hole. But as a former VC, as someone that's been investing for quite some time, it is, dark, I'll say. The numbers show it, but also just the sort of sentiment in the Bay Area. I think you're seeing a lot of funds coming back. A lot of founders are just have a lot of anxiety to raise lots of money. But most of that in Silicon Valley Bank, and some of that turned down. I think they're just excited about how their next capital raises.
The capital market. I'm going to talk from the limited to people that don't know how business works. Venture capital, they invest in startups, but they don't have to put their own money. They have to represent the money from pensions and endowments. So they're actually taking other people's money, taking a management fee off of it, and then investing in startups. So they're taking the management fee because they're doing due diligence, they're sourcing, they're helping portfolio companies. I'm not trying to imply they're not doing anything. They're actually doing a ton of work compared to a lot of people, other people that can manage business is to invest in startups. So when they're not investing in startups, they're not doing anything. And so they're only helping their existing portfolio companies. Going back to the limited partnership, with equities, which is the public stock market, coming down so quickly, and with there being risk-free money available in the bond market, limited partners have been unwilling to take markdown to get liquidity so that they can push it into the VC market. So actually, the venture capitalists have not been willing to make investments because they don't want to ask their investors for money. Because for their investors to put money in this asset class, it's called the denominator. And so we've seen this right now. But with equity making such a huge bounce back, the big question that I want to pose is, are we going to see, I know Jay probably does, I remember Jay a couple weeks ago said this is going to be VC VC market. Not that I'm gonna but the VC market is going to have a pretty big hit, especially with the Silicon Valley Bank. But the question really is, with now the banks seeming to have stabilized, and for people that don't know, Lux Capital just announced another $1 billion fund yesterday. So there is kind of flight to quality for the limited partner class. They're going after the biggest funds and giving more money to them. Just a broader question around the financial sector, especially when it comes to the innovation financial sector, to Eugene's point, are we going to see a resurgence of venture capital, or are we still going to see people be very careful for alt assets and so on? David,
extreme caution. Yeah, extreme caution. The statements that we were saying, that especially when, let's say, environments of low rates leading into higher rates, creates this actual impetus for participants to try to search for yield, whether it's risk yield, or in that sense, it creates this form of, let's say, complexities within the lack of solvencies within the market. Long story short, I don't think that we're going to be seeing the cost of capital mitigate itself anytime soon, and by cost of capital increasing, we're going to see the fluidities of credit and credit compression, as Jay has been talking about throughout the whole space, fairly high. And so once this credit compression cycle is over, then we can actually presume that a lower rate environment coming into play, that we can see more credit acquisitions and credit activity. But until that point, we won't have any fluidity, and this is where it's
会社です。デルの製品があることで、我々のお客さんが安心して我々のソリューションを活用することができます。
もうすぐ繁忙期なのに全然バイトが集まらない。いろいろな求人。
Zambia was here. I got a panel earlier with the finance minister, the Ethiopian finance minister. They're pretty by high levels of debt. So in the point of the detail is Zambia and the MOU. See what this will be. They need to be willing to sign off on the structure of the restructuring.
One big question is transparency and a lack of understanding just how much debt is extended to a lot of developing nations. Do you walk away from the meetings yesterday with a clear sense of how much debt they currently have tied to developing world?
We know quite a bit, but not the full extent. And there were calls yesterday, and there's specific discussion of this, that some people say swap lines by China's central bank should be done out of the restructuring, should be restructuring. There was talk about the what to do with arrears. So as these restructurings drag on, the interest on the interest goes up and up. So can you agree in advance on how to handle that? And so it gets straight into the details. There was a proposal made proposals across the board on how to handle this. So I think there's lots more work to be done, but at least there's a technical workshop that's going to be set up to bring people up to speed on how you calculate net present value reduction within a debt restructure.
Would you identify this, and I think we've just discussed over the last few minutes, as the number one issue that you're handing over to your successor at the World Bank?
Well, certainly debt transparency is a giant issue. There was a call yesterday for the debtor countries to release the contracts that have non-disclosure clauses. So that's a specific thing that will outlast me, and it's not going to get resolved this week, but I hope it does. You know, that China's written into the contracts non-disclosure clauses. That was specifically discussed. So as we look toward the future, I think what I'm handing over to my successor is a World Bank that's in really good shape. That was a main theme from yesterday's meeting. But also a developing world that's under this giant pressure from too much debt, but also not enough growth coming out of the advanced economies.
Well, this might be the end of our conversation. You know that it's great to catch up, David. That's always David Milk. That's the President's over the World Bank.
I think that these are challenging issues. When you talk about the World Bank and aid, we spent the entire time on debt restructuring. This isn't the new one.
I talk about education, about health, but you got to go to poverty.
It's just not done. You can stick around for Gizmo now if you like. Coming up a little bit later this hour. From Washington, D.C. this morning. Good morning, Cassie Barrow, JP Morgan. Coming up next. Lights at Washington, D.C. this morning. Good morning to you all from the IMF Global Headquarters, the nation's capital. Counting it down to the opening bell a couple of hours from now, the market action looking to look something like this on the S&P 500. Equity futures slightly positive by 1/10 of 1% on the Nasdaq. The Nasdaq 100 up by 1/3 of 1% this morning. Just a little bit of a lift in the equity market. No real drama here. The next stock, jobless claims, which are due in about an hour from now. Then on to tomorrow, retail sales and a ton of banking going. So we're going to do a lot of the banks for you tomorrow. Going into all of that, 2 to 10 studies look like this on a 2-year at the moment. Yields in America, high by single basis point 3.97 on a 10-year, high by 2 or 3 basis points to 3.42. Again, no drama there. For once, at the front end of the curve, pretty muted price action with the exception of the move off the back of the CPI report just yesterday. We'll finish on foreign exchange. Here we go. Euro dollar back at 110. Yeah, euro dollar 110.16, positive 0.2 of 1%. That's on a slightly stronger euro in the mix this morning, slightly weaker dollar.
There's equities, bonds, currencies, commodities, and cardinal rule number one is that maybe this is a wake up, getting up through the summer of finding a giveaway in the dollar. With all the dynamics going on, is that one outcome? And it bears really close watching.
So it was interesting yesterday watching the price action of that CPI. You saw yields drop quite aggressively and then come back, Lisa. You saw the dollar weaken quite aggressively and then not come back. That's the story this morning, the euro dollar too.
Well, and again, that's why I go back to, is this dollar weakness or is this euro strength? Because are we getting some sort of strong resounding sense that Europe is in a better position, or is this really a feeling that the U.S. is done with rate hikes or perhaps one more and then we'll be cutting at the end of the year?
I strongly support the study of an asymmetry like that, but then when you triangulate it with another pair, it becomes even more powerful. So the pro case is euro dollar, dollar yen, and then take out the dollar, what euro yen dynamics do, and that'll be something about it.
Listening to that France government this morning, I didn't hear the enthusiasm to keep on hiking after that meeting at all. I still don't believe, and for what's worth, this market still does not believe in this idea that there is a second sequence to this. And the first part of the effort is to get rates very quickly. And this is what Kashkari talked about in that blog to start the year. There is a second piece of this, and it's the waiting, and the waiting, and the waiting. And the market doesn't see it that way. We speak to people in financial markets, they see the pause and cutting as part of the same story. And the Federal Reserve and the ECB do not see that story at all in any way, shape, or form. They see a pause and a hold for a long, long time.
Yeah, I mean, look, this is the unknown, and a lot of people yesterday came on, including Jeff Rosenberg of BlackRock, and said, you know what, we are buying what the market is selling. We think that they're perhaps a little ahead of themselves with the rate cuts. That said, you pointed this out before, John, that where if you hold, it becomes a whole lot more restrictive as the economy continues to slow. We talk about slowing economy, but I have to say, you're not seeing it when it comes to consumer spending. We talked about LVMH, those shares a little change ahead of the market open after rising to a record. But I wanted just to give you a sense before going to the airlines of just how much the Chinese consumer is really driving action. This is to me amazing. Organic sales in the group's biggest unit rose 18%, which was twice the gain that analysts were expecting. So how much is this? People really coming in and having a lot of money to fly around and to buy luxury goods. Delta also out this morning. They actually missed on the first quarter, but they expect the second quarter to be much above expectations. Those shares up nearly 3%. And this is what I find interesting. The revenue per passenger is going up and exceeded expectations. Again, I know this.
I'm not surprised.
I mean, I'm not either, right? So this is basically margins increasing despite all of the discussion about contracting margins, because guess what? They can.
I look at the ratio of business class to economy. It used to be 2 to 1, 3 to 1. Sometimes now it's 7 to 1. And critically, that ratio is within economy going up to stupid levels.
Yeah.
The new $300.
That's always so expensive.
$650.
So expensive. Yeah. And a lot of these airlines are packing up business cabin now as well. They're expanding them.
Yes.
And dropping the first class cabins on these plans as well.
I've noticed that. I've noticed that.
Yeah.
Other airlines are also popping in sympathy, although American Airlines less than United, which I think is interesting. United and Delta kind of shifting away from American.
Just interesting. Subscribe. It's that time of the morning when I say subscribe, because this is time for breakfast a little bit later. Sign up at blackboat.com.
Enthusiasm is just shocking.
For the Grandma newsletter, I've been promoting this all the time. I love your work. You know that. The surveillance newsletter, tacos.com/events. We are going to change the name of that. In the next couple of Give it 2 days.
Surveillance toxic.
Oh, without that.
How do you do it every day?
The daily toxic group.
We're gonna get Kelsey here. How do you blame this out every day? In your 6 hour week?
There is a team, first of all, of people who are
She
There's
has
a
gone
ghostwriting
team.
No.
Well. You got ghostwriters.
I will say this. There is usually when we come in, and I know that you guys do the same thing, there is a theme that you believe in, that you kind of test out. You sort of see where it goes and then figure it out. We have, stuff that
But if you write something like,
She doesn't even do that.
oh, come on! That is just not true. Misinformation.
Tina writers.
Kelsey Barrow's been very picture when you want to read it on its own. The big change it is what they're doing.
Oh yeah, look, this is the view from Cassie Brown this morning. I'll put the point this briefly. Whether or not the Fed follows through the rate hike in May is mostly irrelevant to us. The US economy is increasingly showing signs of weakening growth and disinflation and is more vulnerable to shocks after more than a year of aggressive policy tightening to that end. Here's the good time. We continue to have a bias for lower treasury yields and a steeper treasury curve.
Little Wall Street lean forward now because when the facts change, Kelsey Barrow changes. She works at fixed income JP Morgan Asset Management. What in the blood load, Kelsey? Here, let's get the benchmark on a 10-year yield. How low can it go? Can it go 3 or can it go 2.XX?
Right, so our bias is for treasury yields to move lower. We're expecting for 2-year and the 10-year treasury yields to move towards 3%. So that implies that the yield curve is going to uninvert and is actually going to start steepening. So the things that we're watching right now that are leading us to that conclusion and increasing our confidence around this, you've been mentioning, do we have to wait till the senior loan officer survey that's all the way in May? Well, we're seeing data that's already showing that credit conditions are tightening. So I'll just give you a few examples. NFIB, that came out on Monday. It has a subcomponent about availability of loans. That's the lowest level since 2012. Another one, the American Bankers Association also has a credit conditions index that's the lowest since COVID and even lower than the GFC. So we're seeing it really across the board. The credit condition tightening is occurring.
If I'm going to speculate in the land of Michael and Barrow, what duration do I want to buy to go price up, yield down? What's the most effective duration?
So, well, when we're thinking about the view that the yield curve is going to steepen as well as yields are going to fall, that would imply you want to, have some of your duration in the front end of the curve. That's going to give you your biggest bang for your buck. But on the other hand, we do think that there is merit in locking in longer-term yields here as well. This has been a historic repricing in bonds, and you haven't yet missed the moment to lock those rates in, even though we have seen a rally so far this year. And so that's really what we're looking at. We feel right now that we're in this in-between time, this waiting period. It's this period before when the Fed stops hiking rates and before the Fed starts cutting. And in that period of time, you have the soft landing camp, the hard landing camp, and the recession camp all claiming that they're right. And in reality, what happens is on the path to a recession, we go through a period that looks like a soft landing. So there's been a bit of an improvement in liquidity and sentiment more recently. We wouldn't get complacent about that. We think it's probably temporary. And the next thing we're focused on is bank earnings as well as the debt ceiling.
So, Kelsey, it's a transitory soft landing, and we perhaps will see a transitory type of inflation that will move to something that's lower. How long do we have to wait with inflation well above the Fed's target before it's no longer transitory? We're actually just looking at, say, 3.5% inflation that is basically the new normal for years on out.
So we do have to acknowledge that year-over-year inflation is still high, and that's, of course, a reflection of what's happened over the last 12 months. But, when we look into the CPI report, we see a number of indicators that suggest that inflation should be coming down, that there is more disinflation in the pipeline. So on the good side, supplier deliveries within the ISM are at the lowest level since 2009. Now, if you're at home, that index, supplier deliveries to core CPI, and you're going to see there's a very tight fit, and it suggests there's a lot more shy. Average hourly earnings, the 3-month run rate, it's declined to the lowest level, 3.2%. That's the level that actually the Fed would consider sustainable when they look at it. They think 2% inflation, 1.5% productivity. That gets you to a 3.5% sustainable wage growth. We're actually trending in that direction fairly fast. So, the Fed is going to have to be patient on this one, and they haven't had the luxury of time on their side. But we do think that there is a fair bit of disinflation in the pipeline. The recession is ultimately what's going to get inflation back down to their target. But we do see that there's quite a lot already there in the wings.
Hey, Kelsey, this is great. Kelsey Barrow there, JP Morgan Asset Management, with worth Bob Michael behind it. Did you notice that?
Yeah, but we talk to these people all the time. It's really hard to keep score. I love that there's a
Did I notice that?
Those that work, that is.
Yes, Bob Michael's, yeah. It takes it into JP Morgan.
I love the
I'm so confused.
I love how they change. I mean, it's very cool. These are some real seismic shifts from these major banks on the view.
Can we just share with how Chairman Powell signs it?
There's two things going on here. Surveillance correction here. I thought Nickelback was playing. I have been corrected.
You confused Nickelback and Chairman Powell.
We drew on the dot plots. They're coming up here. Well, Harry, actually, Chairman Powell walking by here near the 50-yard line, and I said, "Come on up and talk to us." And
I'm guessing we can fancy it.
Charlie, you're higher.
What's the genre?
Okay. Come on. There's only one thing.
Jay and the dot plot actually sounds like a good band.
That's
John Lipsky, the former first deputy managing director of the IMF, is going to be joining us shortly. Looking forward to that. From IMF Global HQ, this is what I.
Tom Kane, I can't even Jerome in the dot plots. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Fed officials feel they need to do a little more to tame inflation and are leaning toward another interest rate hike next month. That's according to minutes from their March meeting. This despite forecasts from Fed staff advisors that there will be a mild recession later this year. Another missile launch from North Korea. A suspected intercontinental ballistic missile was fired toward waters off Japan's northern island of Hokkaido. That prompted a brief warning for residents to take shelter. South Korea says it's possible that North Korea may have tested a new type of solid fuel missile. There's a report on the alleged leaker of those U.S. intelligence secrets. According to the Washington Post, it's a young gun enthusiast who worked on a military base and shared the classified documents with a group on Discord, an online platform used by gamers. He was known as OG and told the group he spent some time inside a secure facility. Discord says it's cooperating with authorities. Some fellow Democrats want Senator Dianne Feinstein to resign. The 89-year-old has been absent for about 2 months with a case of shingles. Representative Ro Khanna tweeted that it's obvious she can no longer fulfill her duties. Another Democratic congressman, Dean Phillips, said it was a dereliction of duty for Feinstein to stay on. Feinstein says she's asked to be temporarily replaced on the Judiciary Committee. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
What we shouldn't be doing is saying we've got such a problem with financial stability that we have to in sense aim off a decision on monetary policy which is taken with obviously with our inflation targets when primarily because of conditions in financial stability.
Andrew Bailey there, the Bank of England governor here at the IMF, global headquarters time over the last couple of days. I have to say, TK, that's the view of the Bank of England. We should be very specific about that. That's the view of the Bank of England. A view shared by the ECB. It's a different kind of shock. It's a completely different shock, which is why the Fed's already acknowledged that some I agree. The shock we've seen over the last month would be a substitute for rate hikes. We just don't know how much of a substitute it will be.
Wrapping in their original politics is the fact their core inflation is not our core inflation, and that was nowhere like ours right now. We're doing better here in terms of getting rid of this.
Agree. It's a different story.
Different story. Right now we're going to do this for these IMF and World Bank spring meetings, bring in someone qualified with historical perspective. The academics are Wesley and his Stanford, and of course his work now at Johns Hopkins. John Lipsky Jones is former first deputy managing director at the IMF with all sorts of heritage. I would say, I got to ask the first question, given the times, will you return to the IMF, the World Bank, or other August institutions?
Well, I always enjoy visiting, but I think there's plenty of very capable folks here.
What the state of these institutions now in handling this crisis somewhat different, so different from what you lived in 07, 08?
Oh, yes, absolutely. For one, we didn't have to operate in the sense of the spirit of great power competition. Instead, there was a sense of cooperation. The G20 was formed instantly. The G20 leaders process was created in the wake of the global financial crisis. And if you remember the April 2009 G20 summit, the second summit added $1 trillion of resources to the IMF. So there was real agreement on thematic cooperative action. That still has to be forged, both here at the IMF, at the World Bank, and more broadly.
Well, it's not
the G20 itself.
One of your most historic speeches on the Pacific Rim and a burgeoning Vietnam and Hanoi, as you spoke, of course, to the large China adjacent to Vietnam, how things have changed from when you were on the watch. What is your interpretation of what Washington has to do, what Beijing has to do to get everybody on a more constructive page?
Well, one of the implications of which the changing situation you heard just a few minutes ago from David Malpass, the president of the World Bank, that we have seen coming this crisis, debt crisis, especially of emerging and developing countries, especially affecting the ports. There needs to be a new cooperation forged to deal with that successfully, because the pre-existing Paris Club arrangement simply doesn't work. What you heard about was this debt roundtable that met for the first time yesterday is an attempt to create a new forum for cooperation. Not just China, but also the private sector has felt left out of the negotiations around the process, and they're being brought in. So there's a lot to do, but there's hope that this new format will produce some progress.
Although how much is the largest Republican initiative using lending to the developing world as basically a foreign policy effort in trying to shore up support? How much is that shaping the foundation of the IMF and sort of joint collegial effort to try to support certain nations for the goodness of the world?
Well, the balance has changed a lot. Of course, there's been a lot of bilateral lending that often in the past that always has some kind of a policy focus to it. It's not just for the goodness of the world that these loans are made. So what's happening here, of course, is that the size of China's involvement has become very large. But again, I'm emphasizing, if there's going to be a solution, and now the crisis is coming upon us, a solution is needed. Something has to happen. Everyone's going to have to get a compromise, and the private sector has to be involved in a more direct way than has been.
I want to shift gears a little bit. The IMF came out and said that they see rates going back to where they were pre-pandemic, and eventually we will get inflation back to where it used to be. A lot of people push back, including BlackRock, coming out and saying, Larry Fink saying potentially inflation at 4% for a very long time. Where do you stand on this as a former banker as well as one of the leaders of the IMF?
There I said, one of the secrets of economics is economists have only a weak grasp of the process of price formation. That we've seen over the past decade is that central banks' ability to finally control inflation is much less direct than might have been thought of. So did we see coming the big surge in inflation? Most people did not. Did we feel confident we know what is going to happen with inflation in the next is I think we need to watch carefully that I suspect, I hope that don't get inflation optimism. Less than
well, some people talk about the monetary policy not having as much of an impact as structural change. I think saying he sees the work from home dynamic is actually changing the inflation debate, that the work from home doesn't work and the productivity is dropping off, and that's the reason why inflation is going to stay at 4%. Do you agree?
I said, we'll see. We'll see. All I can say is I find working from home pretty good. I get all that. And among other things, especially dealing with international discussions, it's so easy to connect internationally in a way at a distance that which could have been done before. I don't think that's
in that case, this week, I'll jump in before it gets o'clock. There was a line in there. I think the IMF acknowledging how difficult it is to forecast this stuff. They said our projections are only good as the projections that underpin them. And two of the issues that stand out, I'll pick out two of them. One is this transition to new sources of energy, and the other is deglobalization. And I know many people watching this program right now listening to believe there is a secular component to this inflation story. Do you have any appreciation for that kind of thing, which is what I think Lisa's trying to dig into?
Well, the last 25 years in the United States, inflation has generally been what we do exceptionally below the Fed's target. The notion that this is inherently an inflationary economy is not obvious to me. And right now, we've got people who have bet their personal finances on the maintenance of low inflation. So I think there's going to be a lot of support and policies that will keep inflation low. Because if we fail at that, if interest rates say high, we have not just a fiscal problem, we have a personal finance problem.
I want to ask you as former vice chairman of JP Morgan, Diamond's on target to do 5 days a work week here and lose work from home. Forget about that. This is too important. Can we lose a 2% line? John Taylor of Stanford is adamant there's efficacy to keeping those rules-based structures lower and lower. We have to reset 2% to a higher level.
I don't think so. It's not obvious to me what would be gained at this moment by announcing that we're going to change our definition of where fever-wise, and we're going to decide that actually we can have a higher than 90.6% fever temperature, and it's going to be such a
just hours through there. Those guys are nice coach there.
Hey, John, thanks for this. Just wonderful. John, let's go. With a different views on things. We're going to catch up with Mohammed tomorrow, who I know has a different view on this situation. Let's put it
well, within publishing here, because everyone's publishing here, folks, as we go to these meetings, Richard Clare of the Columbia Economics, as a former vice chairman, recently even suggested not that there would be a policy which he talks about to move away from 2%, but maybe the end result would be higher than a 2% set.
There is this idea in some people, the cynical ones amongst us, believe that this is something that there are some people out there who believe that the Fed may well want to go in this direction, but now is not the time. Now is not the time to make that shift.
There is a tension right now between being aggressive to bring inflation down in a tangible way sooner and having the patience to wait, knowing that if inflation ends up at 3%, it's not the end of the world. Okay, so we can live with that. If it's a temperature at 99, isn't that really a temperature if you're, otherwise?
I got an email. We played drums for Jerome in the dot box.
Who is that?
It's like, it's like Syria that years ago.
I believe it.
He's like a mid-frequent. He's sitting alone in the chair.
He's a player, he's a singer.
He's a singer.
He's a singer and a guitarist. So there's exactly. So you want to say that?
No, I'm not going to say no. But Goolsby plays drums like a Democrat. That's all there is to it. What does that mean? Lipsky got it.
He's like every upset now.
Washington. This is my back.
散歩生命夢のワンタヤキャンペーン実施中。保険のご相談で当てよう。
Fed worries about inflation. We know the GDP growth this week. They'll have a whole host of other problems to contend with. I don't agree with the view that the Fed's going to be cutting rates by the end of the year.
The Federal Reserve that says we're not done hiking. We have more work to do.
I don't think we should feel comfortable that the worst is past us.
It is particularly a period of heightened uncertainty around the outlook.
This is Bloomberg Surveillance, live from the IMF spring meetings in Washington, D.C. with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from the nation's capital for our audience worldwide. Good morning to you all. This is Bloomberg Surveillance on TV and radio. IMF HQ. In a couple of minutes' time, we'll catch up with Gilbert from the International Monetary Fund. The meetings continue down here in Washington, D.C. Going into this morning, equity futures were slightly positive, just turning over in the last couple of minutes. We are negative on the S&P 500. Tom, fantastic guests lined up. We need to talk about the data, though, which we get in about 20 minutes' time.
Data front and center. I want to note that the futures will over because we might soon be on here in moments. But the answer here is claims that 830 has a renewed importance. Lisa mentioned it earlier. There were adjustments. The McKee understands this. I don't, folks, to be honest, but there were adjustments made last week, and we now need to see do those adjustments continue the trend to more claims, potentially higher jobs.
The breakout last week of the those adjustments to the difference between levels and change. The levels are still historically exceptional.
Oh, yes, absolutely.
Exceptionally low, but that change will get your attention if we get that snapping back again.
Yeah, really well said. And the point here is that the pros are looking at not the 190 or the 212 level, 5 level. It's 100,000 up at 310, 325 level. We're a long way from that, but it's the vector. It's the movement up.
The Fed likes to talk about the totality of the data. Lisa, so let's talk about the totality of the data, X non-farm payrolls. If you took payrolls out, the data last week, miss, week, and then bank lending data dreadful. That doesn't look good, does it?
Well, that gave people confidence that was going to come by that much basis points in the next 10 months, and then all of a sudden, bang, everything is over with respect to tightening. We're getting right back to zero. I mean, seriously, people were talking suddenly in a completely different light, and that's the reason why there are these whipsaws that are historic in the bond market the most deep and liquid market out there. So here's the question. Have we truly reset? Are some of the pressures that we have seen truly disinflationary enough to remove inflation from the picture?
You've got some doubts about that. You can ask someone question.
I know. I think that there is an increasing breach between the people who believe that it has to go further and those who think it should hold. And that unspoken reality is those that are more comfortable with inflation remaining higher for longer and those who want to see it come down to 2% more rapidly.
In the zeitgeist, the last 48 hours is a reset on wage growth. And we've heard this from a number of our guests this morning. And you can take the statistics and make whatever you want from them. But I think a lot of Americans on radio and television right now would say, you know what? There was that moment, that glimmer of substantial nominal wage growth. It's vapored in the last 3 months.
We'll be more detailed the next couple of hours, continuing to cover some of these themes, coming up on an extended version of Bloomberg surveillance for the next 2 hours or so. Give open after the International Monetary Fund joining us in the next 10 minutes. Our Gentiloni of the European Commission, Ravi Rajan of the University of Chicago Booth School, formerly, of course, of the Central Bank of India.
Timely as well in the Center for the Equity Markets here. It does dovetail completely into the equity markets. Why don't you bring our esteemed guest for the Thursday address?
Mike Wilson, the Chief US Equity Strategist and Chief Investment Officer over Morgan Stanley, joins us right now. Mike, wonderful to have you on the program. It's always good to see you, buddy. Let's talk about what we're going to hear tomorrow. Bank earnings. Earnings season has arrived. Mike, is this the one where they have to tank guidance because of what we've seen develop over the last month?
Good morning, guys. Good to see you as usual. Look, I think that this earnings season will bring the green the whole time. I mean, I don't think it's that different. We're going to see earnings come down again for the second quarter. We're going to jump over this lower bar. It has come down by about 7% for the first quarter. That's S&P overall. But I do think the banks are going to be, a greater center of attention for obvious reasons. And I think that the more important commentary from the banks is going to be what are they doing with their lending standards? How are they thinking about credit creation? Even more so than what they guided. Okay. I think those stocks have been hit pretty hard because in other words, they've already priced earnings degradation for the banks. Our focus now is equity strategists is what's the impact going to be on the broader economy because that part of the market is only not, small cap stocks about to pick up the gym. Anything that needs capital on a regular basis has been punished. But the S&P 500 hanging around is going to rotate to other areas. So look, if we're going to have a sharp contraction in credit availability and credit options that I expect over the next 12 months, then it's going to continue to water for the stocks. And so the focus for me is going to be on how the rest of the trade kind of back their commentary on credit creation.
Mike Wilson, the partition to changing the weight of equities, or is there immediate efficacy to go to all cash or mostly cash? How do you split the two?
First of all, we never recommend to individual investors or asset owners to go to 100% cash. And that's not a practical strategy for anybody because A, you'd be wrong in your assumptions and in the future. More importantly, that's not the economy vision for the next several years. So we've had this view for a long time, as you guys know. We're in the kind of boom bust boom camp, which means that after we get through the slowdown that we're going through and maybe the recession, slowdown in various parts of the economy, there's going to be another boom coming forward too. And so I think this is one of the reasons why the equity market is not giving it up yet because I think people kind of agree with that view that we had. And they're looking forward and saying, look, I don't want to miss the next upturn. We're willing to miss some of that more than other people because we think the pullback will be more significant. But we don't go 100% cash. We have a high percentage of cash right now because we can pay to hold it.
Given the fact, Mike, that you have seen such resilience in the market, even in the face of what you said already, is what we have been seeing, which is relatively weak earnings. Have you revised upward your target for the S&P, or say the 3,200 bear case isn't really at play anymore?
Well, the way we look at the world and the market is we have a sort of 12-month view and we have a short-term tactical view. And on the sort of year-end target prices, we think those are still accurate. 3,900 are base case for year-end, 4,200 bull case, and then a 3,600 bear case. Those are in place. Okay, those have not changed. The tactical trading path we've got wrong this year is the timing of it. We don't think the path is necessarily wrong. We put those targets at 3,000, 3,300 for a trough cycle in May of last year. It's that hasn't changed. And one that the price and the time, I'm trying to get one range. We've been wrong in the timing for sure. But it doesn't change our view to let that go into the range that has.
How difficult has it made your job, Mike, to see the volatility in the rates market persist to the same degree that we've seen over the past few months?
Well, rate volatility, rate market, I think the way the rate market will be stress is usually the red market, probably the situation with the recession, and we market price down. So, you consider that to be what you want to kind of lean with. We're in the earnings recession, so whether we ever come out of the recession or not, I think it isn't as important as the earnings recession. We're highly confident that that's going to happen. The earnings situation is way worse than what the consensus thinks, which is more in line with what we've been saying all along. And the banking stress only makes us more confident about it.
So, Mike, to get specific here, I don't want to talk about individual names, but if there's 7 stocks in the stock market right now, do you sell? And I'm assuming I'm not buying more of those right now, given Mike Wilson's view. But do you sell it to do something else? Do you put in a put play to protect the downside? What do you do if you've got gains in glorious big tech?
Well, first of all, those 7 stocks are not all tech companies, but what I would say is that they are cyclical companies. Essentially, they are all tied to the economic outcome. And I think that is where we would differ from those people who say, look, these are high-quality businesses, some of them, not all of them. But they're very tied to the economic outcome and the earnings for that situation you see in the customers and their situation. So, look, if you have these various companies, it's so different than last year now. Okay, you just want to make sure you don't have too much exposure to any particular areas of the market that we can get hurt in the economic slowdown that we're envisioning. And like once again, the they're not going to make it in years in the next 4 months.
Like just quickly here, we're at the IMF in DC, and I'm wondering how you incorporate some of these more official group projections in what you do.
Well, I don't want to sound, as if we know anything, but we can focus on our own. You can't rely on other people to do our forecasting for us. I think, to be honest, I think that is part of the issue we have in not just fixed income markets, but also in equity markets. Is I think we've moved to a world where the dispersion of forecasting is very narrow. And this is why when the surprise when the data comes in that's not in line with the tight forecast, the volatility moves can be greater. Okay, so we have our own forecast. We're very confident as confident as we can be in this sort of fortune telling business that we're in. But we do our work and we have to do that.
Mike, that was perfect. That's perfect answer. Mike Wilson, we beat it over that just about a thought. Mike Wilson, do you care about IMF forecast?
Well, I'm curious. Look, I think it's important to understand the divergence between Wall Street and some of the policymakers and how they're coming up with their projections.
That's good. Beat it over that. Here's IMF, the Deputy Managing Director, joining us next. Every futures on the S&P 500, unchanged. From the IMF's global headquarters in Washington, D.C. This is Bloomberg. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The White House is rejecting an outlook for the economy by Federal Reserve staff. Fed Minutes published on Wednesday said the staff sees a mild recession starting later this year. The White House spokeswoman said that data doesn't indicate that, holding out recent numbers on jobs thanks to incentive. Last week's production cuts by OPEC Plus nation will lead to a hefty oil shortfall that will grow as the year progresses. That's according to data from the cartel. A new report says world markets may be undersupplied by about 2 million barrels a day in the fourth quarter. In China, exports unexpectedly rose in March. They jumped 14.8% in U.S. dollar terms from a year earlier. Demand from China and most Asian countries improved. That boosts the economy's outlook and indicates global growth came better than expected. A federal appeals court will allow limited access to the abortion pill. A 3-judge panel partly granted the Biden administration's request to put on hold the Texas court ruling that overturned FDA approval for the medication. On the other hand, it allowed restrictions on abortion that were lifted since 2016 to be reinstated. Delta Airlines is expecting profit this quarter to beat Wall Street estimates. The carrier sees steady bookings heading into the summer travel season. Delta also reiterated its full-year forecast of 15 to 20% revenue growth over 2022. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Financial conditions have tightened to some extent, but it's really in the banking sector that we've seen most of the tightening, and that could have consequences down the line for market volatility. Central banks have to fight inflation and have to keep monetary policy tight, but over time we do expect interest rates to come back down to our star, which we estimate to be similar to pre-COVID.
That's the call from the International Monetary Fund. That was the BSA, the IMF Director of Monetary and Capital Markets. Live from Washington, D.C. this morning. Good morning to you all. Can you get down to the opening about an hour and 14 minutes from now? Every futures on the S&P 500 shaping up as follows. Positive just about 1 tenth of 1% on the S&P 500. The smallest of lifts up 0.05%. This morning. Yields bleeding just a little bit higher by 4 basis points on the 10-year, 343.36. The news this morning, euro dollar reclaiming 110 on the euro against the US dollar on 110.18. We're positive here by 0.2%. Stronger euro in the mix. We've got.
If we get the reach in euro, that's something we're not expecting. It's always speculating among strategists, but I don't think it's like a truly weak dollar.
110.33 the previous intraday high of the year so far. In early February, I think the same day the ECB announced the day before that blowout jobs report. Remember that, more than 500k on payrolls.
It's still at 1 million US jobs in the last 9 days.
It's impressive. 3.5% unemployment.
It's in the IMF survey 5 years out. 500,000. It's there. Right now, an annual visit is we do at these spring meetings with Gita, first Deputy Managing Director of the International Monetary Fund. What she's done critically in the last 90 days is drive forward discussion of crisis and monetary policy and how we're going to extract ourselves from this mess. Dr. Gobin, thank you so much for joining this morning. You mentioned, buried in your wonderful essay, this very idea that inflation becomes unanchored. Is inflation unanchored at this point?
No, not at this point. I mean, if you look at the data, it's squarely anchored in the US and in Europe and several other countries. That's not the concern right now.
The concern right now after the 5-year forecast, it's your fault, we all know that. But the IMF 5-year forecast that we have is 3% or even lower, a little bit lower. It means a disinflation. It means a lower rate regime. If we have an unanchored or an anchored disinflation, does that lead to financial stability within your forecast?
If inflation expectation is the anchor, there are multiple problems associated with that. Firstly, interest rates go up. Policy rates have to rise much faster to bring inflation down. And that can generate much greater financial stress than we have seen. Consequences not just for the country where the tightening is happening, but for a large economy spill over to the rest of the world. So that could be very consequential. And it's one of the downside scenarios we have in our economic outlook, which is if interest rates have to go up much faster and you have much more tightening, we could end up with global growth going as low as, say, 1%, which would be very bad.
So what is the nominal GDP separation of the IMF 5-year forecast? Is it for a dropping disinflation or lower inflation and with a lower real GDP, bringing us down to a truly subdued nominal GDP?
So we have our expectation is that inflation will be conquered over time. It's not going to happen immediately, but if we go into 2024, you're going to see inflation around the world get much closer to central bank targets. Real growth is going to slow also because we don't have any Chinas anymore that that's generating the weakness in your growth. Also, because we have aging demographics. Unless we can find a way to raise productivity, we are going to struggle with our growth. How controversial has your call been that the inflation is going to get back down to where it was close to pre-pandemic even by 2024? If you look at forecasts and if you look at market expectations in the US, you see an even more rapid fall in inflation that's expected. So we're actually on the side of being a little more cautious about how long it's going to take to bring inflation down. But we think the policies will work. There's been some very substantial increase in interest rates. We are seeing now that show up in terms of high-frequency data. This is slowing of the economy. And we think that will bring down inflation. But it will take time. Do you think that the balance of risk has shifted since what we saw with Silicon Valley Bank and with some of the other banking institutions, like huge drop-off in lending that we see peripherally in initial data, that the balance of risks has shifted to perhaps have monetary officials be a little less aggressive when it comes to rate hikes and to err on the side of pausing or even cutting? But as always, central banks need to take into account how economic conditions look. And with the financial stress, we've had a tightening of financial conditions. Bank lending standards have tightened. Smaller banks' credit has weakened. And that will slow the economy down to some extent, which is why central banks may have to do less. But again, I think we're still waiting for more data to show up on exactly how much of an effect that's having.
Okay, so there's a bit of tension between what the IMF has communicated this week and what politicians have responded with. Chancellor Hunt told us yesterday that he disagrees with the forecast. He's entitled to disagree with it. We spoke to Tobias Adrian literally in the last hour, and he said he sees evidence of bank lending contracting in America. Secretary Yellen says she didn't see evidence of that. To explain the daylight between what your institution is saying and what politicians are saying back.
So firstly, I think if you look at the numbers, we're not that far apart. Right? So for instance, in the case of the UK, I think what Jeremy Hunt will recognize is that we've actually had substantial upgrade for UK for this year. It's just that we haven't gone as high as maybe something more than this. But we've actually seen things turn out better than expected in the UK. In the case of credit conditions, again, I think the difference is that Tobias is pointing to all of the credit supply, not just from the large banks. And so you see that the smaller banks, you see suddenly credit is slow. But if you look at the large banks, the credit is only up.
So you don't see the Treasury Secretary misleading us when she says things like she doesn't see evidence of bank lending contracting.
The description that, especially if you look at large banks, you're seeing credit open up. This is the back with the representation again of data at this point.
I look at where we are, and I wonder what the textbooks and the theory that's out there. It seems like everybody's post-pandemic supply-driven dynamics and making it up as they go. And the day-to-day opening after and putting together the blueprint, the world economic outlook, how much are you relying on the traditional economics versus going into a whole new world after all?
Well, I think there are parts that are new and then there are parts that are old and stay the same. So we're using a combination of models, but also going beyond.
Is our starting model right now, you want to do with the Olivia Montard model, is trumpeting the dynamics of our start. Is it useful? Is there an efficacy to traditional John Williams economics?
I think it's very useful input in thinking about how to fashion monetary policy and also fiscal policy. I think, again, it's any input. That cannot be the only thing one is focused on. I think that's what kind of a lot of people say that this group of meetings is somewhat different in nature than previous ones, just because we feel like we're on the precipice of some sort of turning point that we came from, or something new. How would you characterize it in terms of how these meetings are different? And this meeting is different to the extent that we're in this period where, after all the monetary policy tightening that's happened, we are seeing the effect of it because we know all the tightening works with the lag. So I think this is the lag and we're seeing it play out now. There are concerns about how this could play out. As of now, financial policy tools have worked well in being able to cut markets, but there are risks that are out there. The second aspect is we are looking at a period where growth was not going to go back to 2.8%, to be more 2%. And lastly, we have many vulnerable economies around the world with very high levels of debt and debt stress. So, I think we have to all, first of all, recognize that the world economy did better than expected last year. It showed much stronger resilience. We still have tight labor markets. Consumption spending is still holding up. But that said, the balance of risks are squarely to the downside.
But that last one's so important. We've got that. Peter, thank you. As always, to catch up, good to see you in person. So on the resilience of the US labor market in specific has been a standout, I would say, over the last 6 months for sure.
Without question, and all those statistics matter. Many say these weekly claims up front. So,
Jobless claims up next from Washington. This is Bloomberg. Jobless claims data in America around 20 seconds or so away. Live from Washington, D.C. this morning. Good morning to all. Welcome to the program. Some more economic data just around the corner. Piece of break that down for you. Going into it. Equity futures shaping up as follows. The S&P 500 positive by a little more than 1/10 of 1%. Yields a little bit higher by 2 or 3 basis points. A 10-year yield this morning, 3.4186, and euro dollar reclaiming 110. Let's get some of that economic data for you. We can cross over to Mike. Hi, Mike.
Well, John, we seem to be seeing the same pattern in jobless claims that we saw before last week with unemployment claims, first-time claims up 239,000. Remember, last week it was initially reported as 228,000, and that is now it is unrevised. So basically, we're seeing claims intervene. And remember, last week the Labor Department adjusted the seasonal adjustment factors to kind of get some of the pandemic distortions out, and that pushed us up by about 48,000. But if we're staying at the same level here, we're not seeing a major increase in claims. And so that tells sort of the same story. The labor market is doing okay. Continuing claims actually fall 1,810,000 to 1,823,000. So stability in the labor market The other number on this morning is CPI, and this is good news on the Fed front, at least for those who think that it's getting something done. In front of the CPI, the headline number comes down 0.5%. It was down a tenth the prior month, and it was expected to come in flat. That puts the year-over-year number at 2.7%, down from 4.6%. The core rate of just subtracting food and energy down a tenth. The core rate, food, energy, and trade services, which is retail and wholesale and margins, up just a tenth of 8%. The core year-over-year is 3.4%, and the core, including trade, is 3.6%. Let me just mention quickly here the year-over-year headline number revised up to 4.9% for the month of February. So an even bigger drop, 2.7%. We've really seen prices come down at the factory gate, as they would say, over the last month. And so this has got to be good news for the Fed. Doesn't necessarily translate directly into CPI, but it does suggest that inflation is going in the right direction.
True. State prices will run through the states and push it through the equity market and the bond market as well. A couple of ingredients here. On the labour market side, a bit softer. Jobless claims a little bit higher. You look at the disinflationary trends in PPI, put those two ingredients together, and you get the smallest of bits in the bond market. Yields come back down just a little bit by basis point or two on a 2-year, 3.94 on a 10-year. Yields go a little bit higher still, just a touch higher by a single basis point. We take back some of the inflation on these terms, that negative 53 up a couple of basis points on a session. You want to check out the equity market for that. Every small constant for that. It's like if you just positive time, let's call it a quarter of 1%.
The movement here is just as Mike McKee says, it's Fed friendly and it speaks to a disinflation. But Mike McKee, I've got to go back to you before we get to Vince Reinhardt. How much information does this Fed need? I mean, I'm seeing the zeitgeist today framing wage growth that was a generalization that's been cut in half. I'm seeing PPI is a generalization been cut in half, etc. Isn't that enough to make them change, as we heard from Goldman Sachs this morning?
Well, the Fed is going to want to have several months of this kind of data. It certainly is going in the right direction, and it's certainly playing out as they anticipated. The CPI yesterday with the big drop in rents, if that continues, we are going to see them get down to the threes perhaps by the end of the year, which is where they anticipated being. The PPI playing out as anticipated, but maybe even a little more so. The 2/3 of the decline in the index attributed to a drop in goods prices, which we knew had been happening. But listen to this, the index for final demand services fell 0.3%. Services was the area that the Fed is most worried about. So we are seeing prices come off from oil. The question is, does it continue, and does that stabilize wages?
Mike, thank you, sir. Let's return to those markets. Equity futures on the S&P 500 off the back of higher than expected jobless claims, positive 0.2%. I talked about that small move at the front of the yield curve, the 2-year yield coming in, but not even a basis point now. But the move in the FX market just continues to stay. So literally in the last 60 seconds or so, 110.43, the previous intraday high of the year, 110.33, which is where we are right now. But months ago, Tom, 110.43 on euro dollar. That's euro strength dollar weakness. That's the strongest euro against the dollar for the year so far.
You were looking at that. I was triangulating together, folks. I was triangulating again. And we're not where euro is stronger through yen, which is a 147, dare I say, a 148 yen per euro. We're not there yet, but as you say, we're buckets right up in that case on resistance.
At least to breathe some life into that dollar weakness story with this data.
This really is about dollar weakness. It's not necessarily about euro strength. You're seeing, if you look at the Bloomberg dollar index, you see it close to the weakest level of the year, but if you can see that the DXY goes back to also April of 2022. So this is a dollar weakness type of story.
Joining us now, and really well-timed office economic data, is Vincent Reinhardt, the chief economist at Dreyfus and Mellon. Barely describes his contribution to the Federal Reserve System. As head of research for Alan Greenspan for years and years, I can ensure he was the director of adverbs in the Federal Reserve. Vincent, thank you so much for joining us. There is that word out there, suddenly. And you and I know that when you get slowdowns, it usually happens suddenly. Are we at the beginning or the middle of suddenly for this Fed?
I think we're turning the corner towards suddenly and not quite sure what's around the other, down the end of the block. The plain fact is the business cycle is uneven, irregular, a word you would like, quite dynamically driven. And when the unemployment rate starts rising, it tends to keep rising. You don't see it at first, you just see the drips and the drafts, and then it happens all at once. That's how you can have the Federal Reserve staff forecasting a mild recession, even as we're getting data like Mike just reported. Pretty good. An economy that still has some momentum.
Vincent Reinhardt, orthopedics at the Fed 21 years ago, writing about the Great Inflation. We have had a sudden pandemic-driven Great Inflation. Can you state that the Great Inflation of the last 2 years, 3 years is over?
I got the headline you kept repeating, inflation was half, but I keep having to remember where it started, 9%. We can't declare victory yet. The Great Inflation isn't over until the Fed says it is, because they don't need to raise rates anymore. Once we got a run in which inflation is close to goal and people don't care much about inflation, then it's behind us.
Well, Vincent, let's talk about what threshold it would be okay for inflation to fall down to. Are we seeing a greater acceptance, perhaps in backroom discussions, of a 3% inflation rate rather than, say, a 2% target?
I think that's the real risk, that the Fed declares victory too early because it's harder to do otherwise. Chair Powell says 2% is the goal. I'm inclined to believe that that's his definition of price stability, but it will get harder from here on as the unemployment rate starts rising, as inflation is no longer a material threat to economic expansion that people well being. I think you raise the issue. What happens in about 3-4 months when we get another string of good readings on inflation and troubling readings on unemployment. The Fed may declare victory. The problem is not that 2% is immutable. They didn't really have a great discussion of defining price stability as 2%. It's, however, having drawn the line in the sand, you lose credibility if you don't act as it is important.
So, Vincent, here at the IMF in Washington, D.C. at the spring meetings, and there is a belief here that inflation will naturally gravitate back to the pre-pandemic levels and that monetary policy will return also to similar types of ultra-low rates. Do you disagree? Do you think there is a structural component to inflation that is underappreciated in some of these estimates and frankly baked into the market?
So I think there's a couple things going on. The IMF and a lot of analysts think we'll go back to the new normal or the old new normal. I'm running out of adjectives here. And rates will be low. That's possible, but look, for most of history, rates were higher. The anomaly was having a Fed-driven lower for longer episode that suppressed nominal interest rates and kept the real federal funds rate negative. We've broken out of that. Yeah. Not obvious we can get back to it.
It's right on. A breakfast and Vince, wonderful to have your perspective and that view as well. Pushing back against some of the views here at the International Monetary Fund, right here at the headquarters of the IMF, and this is their view. Yeah. And rates go back to this pre-pandemic story. And to Vince's point, it was the last 10 years that were the aberration, the last decade. That was the new normal, so to speak, and Vince is suggesting that maybe we go back to
on an institutional basis, he's always going to support his Fed. Believe me, folks, it was Vincent Reinhardt. Fed, the research capability they put together was first rate. But I agree with you. Yeah, they're making forecasts at the IMF, but institutions have to live it, and the institutions just aren't there yet. Looking out to 25, or driving 25, or dare I say even 24, they're not there yet.
Let's just recap some of the data if you want to tune in welcome to the program. So what we have here is jobless claims a little bit higher than expected, 239,000. The estimates are 135. PPI, factory gate inflation. PPI, Lisa, falling in March by the most since the start of the pandemic. That's the lead paragraph of Repick at Bloomberg.
And that really is the lead for the market reaction as well, where you see yields marginally lower and you have this sort of tepid pop in equities, but it's not overwhelmingly excited because frankly we are seeing weakness in the economy. Does this read through to CPI? Is this enough disinflation? And we knew that there would be disinflation, but where does it go?
There's a big question in Washington. Does Europe have a coherent view on China? Coming up next, Paolo Gentiloni, the EU Commissioner for the Economy and Financial Affairs. That conversation up next.
Today with me from around the world with the third word, I'm Mateo. Fed officials feel they need to do a little more to tame inflation and are leaning toward another interest rate hike next month. That's according to minutes from their March meeting. This despite forecasts from Fed staff advisors that say there will be a mild recession later this year. Another missile launch from North Korea, a suspected intercontinental ballistic missile, was fired toward waters off Japan's northern island of Hokkaido. That prompted a brief warning from residents to take shelter. South Korea says it's possible that North Korea may have tested a new type of solid fuel missile. There's a report on the alleged behavior of the U.S. intelligence secret. According to the Washington Post, it's a young gun enthusiast who worked on a military base and shared the classified documents with a group on Discord, an online platform that's used by gamers. He was known as OG and told the group he spent some time inside a secret facility. Discord says it's cooperating with parties. And SoftBank is cashing in on its long-held stake in Alibaba. It sold $7.3 billion in shares of the Chinese internet giant this year. That's after selling billions more in shares last year. SoftBank once owned a third of Alibaba. Most of that came from early $20 million investment in one of venture capital's most famous bets. And Delta Airlines is expecting profit this quarter to beat Wall Street estimates. The carrier sees steady bookings heading into the summer travel season. Delta also reiterated its full-year forecast of 15 to 20% revenue growth over 2022. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
In effect, this affects giant duration. So what that meant is it distorted all world markets, and we're now in the world markets. We'll have to get normalization of interest rates to begin to have pressure on asset prices for a long period of time.
That was David Nalpasky, President of the World Bank, joining us here at IMF HQ in Washington, D.C. From Washington this morning, good morning to you all. Also counting it down to the opening bell, about 44 minutes from now, with equity futures on the S&P 500 positive by a third of 1%. Literally about 16 minutes ago, we had some economic data out of the United States. Jobless claims a little bit higher than expected. PPI, factory gate inflation coming in a little bit softer than expected. That brings some life into the equity market, taking some life away from the US dollar. Euro dollar breaking down to 110.43 at one point, new intraday high for the year on the euro against the US dollar. It's on right now at 130. The euro stronger dollar, weak, the euro stronger by a third of 1%.
Here, we're talking about our money. We could US dollar, maybe wait 2 months, maybe 3 years from now. There is a longer time frame here. But far more importantly, is the outrageous demand of the Bloomberg surveillance team that would focus on on the matter right now. So it's going to be some next. Yes, John. And wonderful that Ted Lasso is taking an Italian play off AC Milan and a new character in. But the tensions, as I saw going through Chelsea yesterday, and the tensions of your AC Milan is that this is how you pronounce it.
Well, the Commission supports Juventus, but really, I don't think he wants to talk about it a lot of Juventus.
It may not be, but it shows the tensions that are out there.
Good reason for that. There's a lot of Juventus now, but he's Commissioner for Economic and Financial. Commissioner, good morning. Talk about you. Don't worry about it. I want to talk about something much more difficult. Let's start with this question. Does Europe have a coherent approach to China? And if you do, what is it?
Well, I think we do. This is the obvious answer. It is evolved, this attitude, since 3-4 years. Our attitude 3-4 years ago was the attitude of, well, we have important trade relations, and whatever they are, we will strengthen these trade relations. Now I think we are very clearly on the perspective to rebalance these trade relations. Also, leave behind a certain ingenuity that we had in hoping that this trade relation, in that sense, would be in an equal treatment, in a level playing field, which was not completely the case. So we are still cooperating economically, but we have also a geopolitical perspective, which is, of course,